Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And as usual, we are just absolutely appreciative that you are able to join us today because we have a lot to go through. We completed our overall portfolio transition to what we call the new secular theme for the 2020s, that rebuilding of the West. But just as important, we want to go through some of the factors that are going to impact performance both over the short term and, just as important and even more important, the long term. And this week's presentation is called The Battle for Leadership, because right now, ladies and gentlemen, the stock market is going through what we call this once in a decade leadership battle, and transitions are sloppy. We're going to have days where the new guard, and if we're right about that, we're talking the commodities, the banks, the industrials. Those will be the areas that outperform. Then we're going to have other days where the S&P 500 itself looks very strong because technology, the old guard that's been in charge for the last 10 years, has a short cover rally or fights back and doesn't want to voluntarily give up that leadership. And those are going to be days where we underperform. Why? Because our technology weight is now 0%. And so we're going to go through all of that today because it's important to understand that while these established leaders are weakening in technology and software, they don't go away quietly. And it's going to be this constant tug of war that takes place over the next few months as we rotate into the new decade. Second, new leaders must convince a skeptical crowd. What do we mean by that? Well, most mutual funds, hedge funds, pension funds out there are all overweight technology. Your neighbor is overweight technology. Your kids are overweight technology. Everyone is overweight technology, which means that no one's overweight those other areas of the market. And why? Because quite frankly, they've been awful areas to invest in for the last decade. They've been dead money. And so as those areas emerge, they're going to climb up what we call this wall of skepticism, this wall of worry. And that's the opportunity. That's where we can potentially outperform. If we position in those areas early in the second and third innings, remember, we never invest in the first inning, and we try not to be around for the ninth inning of overall market cycles. And so we have to convince that skeptical crowd. And then lastly, but certainly not least, the US dollar is going through a major structural shift, and how the US dollar trades often in history has an impact with how we need to allocate assets as investors. Are we long commodities or are we long innovation? That is usually driven by the US dollar index, believe it or not. Now, from a trade condition standpoint, technology is in a very, very dangerous spot right here. I cannot stress that enough, ladies and gentlemen. We've had a big, broad top in technology, but now we're getting these enticing short cover rallies, such as we saw both late on the day, Wednesday, and into Thursday when we're recording this episode. The most violent rallies usually occur in the market or in a respective sector during a bear market, during the emergence of a bear market. And in technology, we believe we're in the early innings of a developing bear market. And so when we get these big short cover rallies, we're going to underperform. Why? Because it's 40% of the S&P 500 and our weight there is 0. But we're trying to avoid some potentially serious damage over the next few months in technology. And I can't stress this enough, whether your money's with us or it's at home and you're doing it yourself or with another manager, please avoid technology. It's an area of high risk right now. We cannot stress that enough. Second, the US dollar is beginning to break down. When the US dollar breaks down, quite simply, positive for commodities and positive for the banks when we have a steepening yield curve as it relates to a bottoming in European rates and those investors selling US dollars to bring that money back over to Europe. So steepening yield curve, good for banks. Breaking down of the US dollar, that's good for commodities, and that's bad for domestic innovation based types of stocks, those types of stocks, pardon me. Lastly, any pullback we see in this emerging leadership, such as energy, industrials, materials, we need to buy those pullbacks because right now they're in the second or third inning versus the ninth inning over in technology. We want to be early investors. We don't want to be late investors. Important point and distinction there. And then lastly, gold and silver breaking out. What does that mean? Well, that actually ties in with the US dollar. The other area that benefits from US dollar weakness, gold and silver. Why? Gold and silver are not protection assets like most people believe. They are hedges against US dollar currency risk. In other words, if you think the US dollar goes down, gold is a hedge against your US dollar exposure. So when we go into a bear market for the US dollar like we did in the 2000s, you want to be long gold, energy, materials, and the banks. The banks tend to outperform during dollar bear markets. Important point. And that's how we're positioning the portfolio. So we saw here, previous tech peak was in 2000. That was when the US dollar started to break down lower. And we saw the birth of the commodity cycle. Just happened to be that was also the beginning of building China. Now, we got a double top in the US dollar. And guess what? We're starting to see commodities act a lot better. And coinciding with a rebuilding of the West. Perhaps the most important chart you will look back over the next 10 years and you say it was all about the US dollar. You heard it here first. Now, the technology sector, broad breakdown. This is a weekly chart of technology. A double top on the overall weekly chart. That's a very bearish development. And then a failed rally in the month of April. And coinciding with that, we saw the moving averages starting to roll over, unlike other sectors where we saw new highs. And of course, the RSI breakdown, which stands for Relative Strength Index. The relative strength of technology, while we do have these violent one-day rallies, is rolling over. So when you get these 3 points that align and ownership being so high in this dominant sector right now, that is a very, very structurally bearish development for technology. And it's something we want to be very careful in. If we're early, that's fine. The same way we were early with Ethereum, it's fine. It's better to sell and make some money today and have that money to buy cheap assets tomorrow versus going through the entire pain of the bear cycle in technology. And we see that here. 40% of the S&P 500 is technology and communications. That's a lot. We look at energy, it's about 2.28%. Materials, 2.4%. The combined weight of those two sectors, only 5% of the S&P 500. Can you imagine what would happen if just a small piece of that money rotates out of technology and into energy and materials? It would have an outsized impact versus how much more money can possibly go into technology? That's the other structural problem with technology at this point, is that there's not enough money out there to drive asset prices higher. So improving fundamentals, good technical backdrop, plus room for fund flow expansion, which is what we see with energy, materials, and the banks, that's how you can generate alpha. Because if we're underweight the area of structural weakness, which is 40% of the market, that's how we can outperform. But it takes time. And then Bitcoin, 3 weeks ago, we made a tough decision to sell Ethereum, and it was not a popular one amongst our investor base, I can tell you that. But I think after yesterday and after the last week, we're starting to see the fruits of that decision. And there's a point to why we're bringing this up, and it is absolutely not to pat ourselves on the back on this. It is to go back to our decision to go to 0% technology, to go overweight commodities, the banks, industrials, materials, because it takes time. Sometimes when you make these big rotations in a portfolio, you're not going to next day and it's off to the races, off to the moon. That's not how it works. It's a process. And so when we see these structural bear trends taking place, we move away. And you know what? We might leave a little bit of return on the table over the next week, 2 weeks, or on any individual day. And that's okay, because our first priority is to protect capital. Our second priority is to grow that capital. And that's what we're trying to do here at LifePro. We talked about gold and it's benefiting from the US dollar weakness. It's also, we believe, benefiting from the collapse of Bitcoin. Bitcoin's often marketed as a gold alternative. Well, take a look at this. As Bitcoin has collapsed, gold has started to break out relative to Bitcoin, even though they're supposed to do the same thing. And if we look at the gold sector ETFs, breaking out of a multi-month consolidation. Part of the reason why we've increased our exposure to gold over the last 2 weeks. Market-wise, we see, again, failed rallies in the VIX. We tried the pop here, VIX tried the pop and it failed. Another pop last week and it failed viciously and we had that big rally. Remember, we mentioned that last week. We expected a fail in the VIX. And then again this week, yesterday, another pop in the VIX, but at a lower high than last week, overall forming a very bearish head and shoulders formation. A bearish VIX is bullish for the stock market, just to be clear about that. And then, of course, we have over $3 trillion, as we can see here on the chart on the right, of institutional investor cash that's sitting on the sidelines. That is bullish. So when investor cash is at record lows, you want to be bearish. When it's sitting close to highs, you want to be bullish because that's dry powder that can push asset prices higher in the future. Very important point. And again, we look at the credit markets relative to the VIX. They tend to be correlated with the exception of the last month. VIX has widened out, but credit markets have stayed rock solid. The credit markets are our navigator of choice, right? When we look to, the stars of capital markets to navigate our ship, we always look to that North Star, which is the credit markets. That is the ultimate supplier of capital to those people and businesses that need money and drive the economy. When credit spreads are tight, when credit is cheap and accessible, the economy grows and markets function properly. And of course, COVID cases continue to collapse. So collapsing COVID cases, higher potential GDP, 10 states with fewer than 100 cases of new COVID cases. That all spells, again, higher GDP, higher economic activity, higher spending, good for the market, good for those stocks that benefit from a rising economy. And when we look at energy, ladies and gentlemen, 10 years of being in a bear market. You lost money if you've been in best of breed energy companies going back to 2010. We've had a collapse in investment, even though consumption of oil and energy products is at an all-time high here in the US. We can't respond supply-wise because that investment has collapsed. Those companies aren't able to respond. So what do we want to do? We want to be long companies that benefit today from a rising price in oil because the Biden administration's cracked down on permitting. So companies that have production in place that can flow oil out of the ground today with high reserves in place to keep that production going. Second, companies that benefit from an increase of required investment to maintain production where it is today. So the oil service companies, that's an important point, ladies and gentlemen. That's why we love energy so much. So overall, as markets enter this generational leadership change, stick to the big picture. Don't get lost in the day-to-day. That's how you lose money. That's how you leave opportunity on the table. Stick to the big picture. That's how you build wealth. We want to sell rallies in technology. We want to buy sell-offs in commodities. Over time, that should lead to alpha generation if our research is correct. Our technology weight is now 0%. That means when you see the market up a lot and it's led by technology, we're going to underperform on those days. When the market's up or when energy, commodities, banks, industrials, and they're up, we outperform. So that's the way to kind of think about our performance on a day-to-day basis. And of course, that secular US dollar weakness is what is really driving this generational shift in asset flows. We want to pay attention to it. Don't fight that big generational trend. So once again, ladies and gentlemen, thank you for all of your time, for all of your friendship and mentorship that we receive from all of our advisors and clients. We just are absolutely appreciative of all your business. And if you have any questions, please feel free to reach out to your advisor or reach out to us directly at 888-543-3776 or on my cell phone at 858-354-5114. Thank you again and have an absolutely fantastic weekend.